Here is a synthesized talk based on Warren Buffett's writings. I made this audio file to summarize some of his best ideas about investing.
This video is brought to you by Bud Leviton, author of The Four Filters Invention of Warren Buffett and Charlie Munger.
If I were looking at a company, I would put myself in the frame of mind that I had just inherited that company and it was the only asset my family was ever going to own. What would I do with it? What am I thinking about? What am I worried about? Who are my customers? Go out and talk to them. Find out the strengths and weaknesses of this particular company versus other ones. Our formula is the purchase at sensible prices of businesses that have good underlying economics and are run by honest and able people. We believe that our formula is certain to produce reasonable success and we expect to keep on doing well. When buying companies or common stocks, we look for understandable first-class businesses with enduring competitive advantages accompanied by first-class managements. We like a business with enduring competitive advantages that is run by able and owner-oriented people. When these attributes exist and when we can make purchases at sensible prices, it is hard to go wrong. The majority of our companies have important competitive advantages that will endure over time. It is comforting to be in a business where some mistakes can be made and yet a quite satisfactory overall performance can be achieved. Our advantage is attitude. We learned from Ben Graham that the key to successful investing was the purchase of shares in good businesses when market prices were at a large discount from underlying business values. When you invest, focus on your circle of competence. Draw a circle around the businesses you understand, and then eliminate those that fail to qualify, on the basis of value, good management, and limited exposure to hard times. Think for yourself. I read annual reports of the company I'm looking at, and I read the annual reports of the competitors. That is the main source of the material. Never mind what the professors say about efficient market theories. For me, it's what's available at the time. Charlie Munger and I are not interested in categories per se. We are interested in value. For some reason, people take their cues from price action rather than from values. In investing, I went the whole gamut. I collected charts, and I read all the technical stuff. I even listened to tips. And then in 1949, I picked up Ben Graham's The Intelligent Investor, and that was like seeing the light. Prior to that, I had been investing with my glands, instead of my head. If Graham's 3 basic ideas are really ground into your intellectual framework, you can do reasonably well in stocks. His 3 basic ideas, and none of them are complicated or require any mathematical talent, are: 1. That you should look at stocks as part ownership of a business. 2. That you should look at market fluctuations in terms of his Mr. Market example, and make them your friend rather than your enemy, by essentially profiting from folly, rather than participating in it. And finally, 3. The 3 most important words in investing are margin of safety, which Ben talked about in his last chapter of The Intelligent Investor, always building a £15,000 bridge, if you're going to be driving £10,000 trucks across it. I think those 3 ideas, 100 years from now, will still be regarded as the 3 cornerstones of sound investment. Keep it simple. An investor cannot obtain superior profits from stocks by simply committing to a specific investment category or style. He or she can earn them only by carefully evaluating facts and continuously exercising discipline. The common intellectual theme of the disciplined investors, from Graham and Doddsville, is this: they search for discrepancies between the value of a business and the price of small pieces of that business in the market. Over time, we learned that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Charlie Munger understood this early. I was a slow learner. My pal and partner, Charlie Munger, is a Harvard Law graduate who set up a major law firm. I ran into him in about 1960 and told him that law was fine as a hobby, but he could do better. He set up a partnership that was quite the opposite of investors from Graham and Doddsville. His portfolio was concentrated in very few securities, and therefore his record was much more volatile, but it was based on the same discount from value approach. He was willing to accept greater peaks and valleys of performance. When he ran his partnership, however, his portfolio holdings were almost completely different from mine and the other fellows, but he followed the Graham and Dodd approach of seeking a bargain. Charlie said, "Let's go for the wonderful business." We both realized that time is the friend of the wonderful business, and the enemy of the mediocre. You might think this principle is obvious, but I had to learn it the hard way. In fact, I had to learn it several times over. Another influence was Phil Fisher. I met Phil Fisher in the early 60s, after reading his first book. His ideas, like those of Ben Graham, were simple but powerful, and I wanted to meet the man whose teachings had such an influence on me. It's been many years since I integrated Phil's thinking into my investment philosophy. As a consequence, Berkshire Hathaway shareholders are far wealthier than they otherwise would have been. Investors should remember that their scorecard is not computed using Olympic diving methods. Degree of difficulty doesn't count. Keep it simple. If you are right about a business, whose value is largely dependent on a single key factor, that is both easy to understand and enduring, the payoff is the same as if you had correctly analyzed an investment alternative, characterized by constantly shifting and complex variables. We try to price rather than time purchases. In our view, it is folly to forego buying shares in an outstanding business, whose long-term future is predictable. Short-term worries about an economy, or a stock market, can be unpredictable. If we stray, we will have done so inadvertently, not because we got restless, and substituted hope for rationality. I made a study back when I ran an investment partnership, that showed me that my larger investments always did better than my smaller investments. There is a threshold of examination and criticism and knowledge that has to be overcome or reached in making a big decision. You can get sloppy about small decisions. Keep it simple. If you need a calculator or a computer, you've got no business playing the game. Instead, in business schools, something is taught that is difficult but not useful. The business schools reward complex behavior more than simple behavior, but simple behavior is often more effective. I put heavy weight on certainty. Use probability in your favor, and avoid risk. It's not risky to buy securities at a fraction of what they are worth. Don't gamble. You're dealing with a lot of silly people in the marketplace. It's like a great big casino, and everyone else is boozing. Watch for unusual circumstances. Great investment opportunities can come around when excellent companies are surrounded by unusual circumstances that can cause the stock to be misappraised. In optimizing the odds, I think of the baseball hitter Ted Williams. Ted Williams explained how he increased his probability of hitting. My argument is, to be a good hitter, you've got to get a good ball to hit. It's the first rule in the book. If I have to bite at stuff that is out of my happy zone, I'm not a 344 hitter. I might only be a 250 hitter. Charlie and I agree, and will try to wait for valuable opportunities that are well within our own circle of competence. In the theory of investment value, John Burr Williams described the equation for value. The value of any stock, bond, or business today is determined by the cash inflows and outflows, discounted at an appropriate interest rate that can be expected to occur during the remaining life of the asset. Note that the formula is the same for stocks as it is for bonds. Even so, there is an important and difficult to deal with difference between the two. A bond has a coupon and maturity date that define future cash flows, but in the case of equities, the investment analyst must himself estimate the future coupons. Furthermore, the quality of management affects the bond coupon only rarely, chiefly when management is so inept or dishonest, that payment of interest is suspended. In contrast, the ability of management can dramatically affect the equity coupons. The investment shown, by the discounted flows of cash calculation, to be the cheapest, is the one that the investor should purchase. Irrespective of whether the business grows or doesn't, displays volatility or smoothness in its earnings, or carries a high price, or low price, in relation to its current earnings and book value, the cheapest investment, shown by the discounted flows of cash, is the one that the investor should purchase. Investing in bonds, and investing in stocks, are alike in certain ways. Both activities require us to make a price-to-value calculation, and also, to scan hundreds of securities, to find the very few that have attractive reward-to-risk ratios. An investor cannot obtain superior profits from stocks by simply committing to a specific investment category or style. He or she can earn them only by carefully evaluating facts and continuously exercising discipline. As you may know, we buy marketable stocks for our insurance companies, based upon the criteria we would apply in the purchase of an entire business. This business valuation approach is not widespread among professional money managers, and it is scorned by many academics. Nevertheless, it has served its followers well. Simply put, we feel that, if we can buy small pieces of businesses, with satisfactory underlying economics, at a fraction of the per-share value of the entire business, something good is likely to happen to us, particularly, if we own a group of such securities. We extended this business valuation approach, even to bond purchases. We select our marketable equity securities, in much the same way we would evaluate a business for acquisition in its entirety. We want the business to be, 1. One that we can understand, 2. With favorable long-term prospects, 3. Operated by honest and competent people, and 4. Available at a very attractive price. We ordinarily make no attempt to buy equities for anticipated favorable stock price behavior in the short term. In fact, if their business experience continues to satisfy us, we welcome lower market prices of stocks we own, as an opportunity to acquire even more of a good thing, at a better price. Before looking at new investments, we consider adding to old ones. If a business is attractive enough to buy once, it may well pay to repeat the process. In the stock market, however, an investor frequently gets the chance to increase his economic interest in businesses he knows and likes. People talk about growth versus value. In our opinion, the two approaches are joined at the hip. Growth is always a component in the calculation of value. Growth is a variable whose importance can range from negligible to enormous, and whose impact can be negative, as well as positive. We just read the newspapers, think about a few of the big propositions, and go by our own sense of probabilities. Obviously, every investor will make mistakes. By confining himself to a relatively few easy-to-understand cases, a reasonably intelligent, informed, and diligent person can judge investment risks with a useful degree of accuracy. It is no sin to miss a great opportunity outside one's area of competence. But, I have passed on a couple of big purchases that were served up to me on a platter, and that I was fully capable of understanding. We love owning stocks, if they can be purchased at attractive prices. However, unless we see a very high probability of at least 10% pre-tax returns, which can translate to 6.5–7% after corporate tax, we will sit on the sidelines. With short-term money returning less than 1% after tax, sitting it out is no fun. But occasionally, successful investing requires inactivity.
This video is brought to you by Bud Lebeaton, author of The Four Filters Invention of Warren Buffett and Charlie Munger.